Good morning and welcome to this week's Market Thinkers discussion. This week I'm joined by my business partner Drew Meredith and Chris Joye from Coolabah Capital. Hi Drew. Hi Chris.
Hi Jamie.
Every week we bring insights from portfolio managers, CEOs, thought leaders and investment experts in the attempt to bring the investor, you, closer to the coalface. It's very much what Drew and I and our team see every day. First, for the listeners, Wattle Partners is a fee-for-service wealth management firm based in Melbourne. As the name suggests, we manage money for individuals, mums and dads, superannuation, trusts, foundations, and various other pools of capital. We tailor portfolio construction to the client's risk appetite, return objective, and any overlays like ESG. The origins of our firm date back to 1973 when Austin Donnelly founded this group. He was really an advocate for investor rights and what we think was the first fee-for-service independent financial planning firm in Australia with dealer's license #1 in Queensland. In this session, we're happy to welcome Chris Joye from Coolabah Capital, a specialist cash and fixed income manager in Australia. He runs the Smarter Money suite of funds and is well known for his column in the AFR. We've known Chris for over 5 years now, and his venture has been in funds management has been super successful. We first met Chris when he only managed $150 million. I think he now manages close to $4 billion. Inspirational story on its own. Today we will talk about a lot of things. We'll talk about Chris's funds. We'll talk about the outlook for property. We'll talk about the outlook for the economy. Just the format, just for anyone that hasn't joined us before, Drew will talk about why Smarter Money funds have been included in our model portfolio and where they fit. We'll then ask Chris 10 quick fire questions to lighten the mood of the session, and then we'll get into Q&A where we cover the points that I mentioned before. Drew?
Thanks, Jamie. Yeah, I think the best place to start is why we added Coolabah and Smarter Money. So Coolabah is the asset management group, and Smarter Money are the products. Basically, with interest rates zero, dividend cuts going on everywhere, and this was 3 or 4 years ago, even 5 years ago. We need to get the most out of our clients' cash holdings, and people were either being forced to take on more risk, so go into lower quality assets, or accept lower incomes. We think Smarter Money sits in between, where Chris's team basically via active management are able to deliver much better returns than the income that you can get from a government or other bond. I know most people probably think holding cash or an active cash just means putting money in the bank or Rabo Direct, but as Chris will explain, it's part of that. But there's a lot more very short-term, low-risk assets that can be used, and the big thing we have liked about Coolabah is, as Chris will also go into detail, is they just stand out with their ability to collate, prepare, and analyze data on everything from bond prices to the pandemic, which is probably one of the more interesting reads over the last 6 months, particularly for us in Victoria. We're pretty hopeful. So welcome, Chris. And I think Jamie's going to shoot those questions at you.
Thanks, guys.
All right, Chris, it's 10 questions, quick fire answers as much as you can. We'll start now. What is the best investment you've ever bought?
Frankly,
maybe Coolabah.
Yeah, I think starting Coolabah was probably #1. Buying a house was #2.
In Sydney.
In Sydney, yeah, that's right. But I started Coolabah in 2011. We're now running over $4.4 billion. I have a team of 25 guys, 13 analysts, 5 portfolio managers spread across London, Sydney, and Melbourne. I love my job. I want to do it forever. So definitely running my own business, but also managing money has been the most fulfilling investment.
So what's your biggest investment regret, Chris?
To be honest, I mean, right now, contemporaneously, I kind of feel that I had a call with a client of mine, a very, very large family office in March, and he brought together his top fund managers globally, and they said, what do you think the best investment will be over the next 1 to 2 years? And my response was 10 times levered residential real estate.
Yeah.
That's starting to play out big time. If I had more time on my hands, I would have liked to have bought some more resi property. So that's probably the most relevant recent regret. But otherwise, I don't think I have too many regrets. Notwithstanding that, you're always learning and iterating and educating yourself and your team. And you know, I often use the analogy. I feel like we're a kind of I'll use an AFL example, but I feel like we're probably a 24-year-old or a 25-year-old AFL player that's constantly maturing and evolving as they get the benefit of new experiences.
Got it. What is the one red flag for any investment?
Yeah, I think in relation to management, I think if there's ever a disconnect between practice and reality and communications and perceptions, that's a huge issue for us. Specifically in the bond market, we are very, very concerned about where we see a conflict of interest between management, which tend to be dominated by shareholders. So
Yep.
Executives are often large shareholders in the business, and creditors. So a bank is a classic example. CBA's balance sheet has about probably 6 to 8% equity and about 92% debt. And we often, over the years, with banks, have seen big conflicts of interest between what management wants to do as a shareholder, and often that involves taking high-risk bets, expanding into Asia, buying non-core businesses, running excessively risky lending practices, and the interests of creditors or the owners of debt. So that, in the case of a bank, could involve depositors and bondholders higher up the capital stack. So I'm very, very focused when we're investing on looking for management teams that are in turn focused on an alignment of interests and that consistently under-promise and over-deliver, but also management that isn't dysfunctional in the context of the sometimes conflicting interests of debt and equity.
So I think this is going to be the longest 10 quick fire questions we've ever gone, but I'm going to ask you a question on that point. As a debt manager versus an equity manager, do you see management through a different lens?
Yeah, absolutely. And we often battle management because we're massively activist. So we're heavily engaged with CEOs, CFOs, treasurers. I'm sure if any of them are watching this right now, they will have a quiet chuckle because they know that I harass them regularly. And if we kind of, I guess we're very intense individuals, and we're very aggressive and assertive in protecting our investors' interests.
Yep.
And basically we like our credits, that means our companies, to behave in the best interests of creditors. So yeah.
And having the media per se on your side, e.g. writing a column once or twice in the AFR, does that help you with your persuasion of your views?
It certainly provides a platform, but I think a lot of fund managers, the AFR runs columns from lots of fund managers, and it's quite common around the world for fund managers to write columns in newspapers. Roger Montgomery is an example, I think, at the Australian as an equity manager. But I should say, you guys probably don't know this, we do actually run some equities. So we run for a super fund what is called a full capital structure mandate, where I can invest in the cash deposits of a company, their senior bonds, their subordinated bonds, their hybrids, and their equities. Now, in that particular mandate, we own ANZ, NAB, and Westpac equity. So we bought their shares 1 to 2 months ago, and they've performed really well since. So we see that as a situation where there's a coincidence of interest across the capital stack. But it's interesting, like across that capital structure right now, for example, we used to own lots of the major bank senior bonds, but we regard them as being very expensive. So we've actually sold 2.24 billion of their senior, and we don't hold much of their cash, but we do own their subordinated bonds, hybrids, and equity. It's
a really interesting mandate. Was that designed by the super fund that came to you, or is that one of your ideas? Yeah, this super fund, I can't name them, but they are the best performing super fund in Australia over 1, 2, 3, 4, 5 years in fixed income.
and according to the super rating survey.
Catholic
they're
super,
very,
yeah.
very creative, really ingenious guys, and crazy smart, very tough. I call one of them the great white shark because every time I talk to him, it feels like he's going to rip a limb off me. But these guys, they tend to have a very, adversarial is the wrong way, but they're very tough on their fund managers. But they've been very, very good clients to us. And they came to us and said, listen, you guys trade the full capital structure so well. You dominate the market. We're the most active trader in Australia in bank senior bonds, bank subordinated bonds, and bank hybrids. Why wouldn't you go one notch down the capital stack into bank equities if you see an opportunity? And that's what we've done. They've given us a very, very high return target on that mandate. So I've got to beat the government 10-year government bond yield plus 11%.
11.
That's my return target.
Isn't equity premium normally 7? Is it 11%?
Yeah, I think the last 100 years, the Aussie equity risk premium over 10-year government bonds has been between 5.5% to 6.5%. So that's a really punitively ambitious mandate from my perspective. But I can say that since inception, we have beaten that mandate. We're up 4.5% in this month alone in that particular portfolio. So listen, it's not something that I want to do regularly, but we did see an opportunity when three of the four major banks were trading at about 0.8 times book value 1 or 2 months ago. And we thought they'd over provision for bad debts. We'll talk about this later. We thought the housing cycle would be much more resilient than almost everybody. And we thought they'd be writing back those bad debt provisions, and they would normalise their dividend payments more quickly than the market expected. And generally, the Aussie macro environment would be much better than expected. We forecast that the jobless rate would be 6 to 7% relatively quickly. It's right now 6.9. Everyone else was at around 10%. And bank stocks have started to perform. So that's one reason why that portfolio is doing well.
Well, they got bullied into it, didn't they? They're bullied by everyone to cut that.
Listen,
dividend.
as a creditor, so this is a good example of what we were talking about earlier. So I was 100% on side with APRA in terms of more or less
bullied by you too.
Exercising moral suasion to convince the banks not to pay dividends.
Yep.
Because that protects creditors. It's not great for shareholders, but they build up their capital.
Yep.
And they build up their first loss reserve. So that's really good for me and my investors. But it's also the prudent thing to do in the first recession since 1991. You don't want banks kind of flushing out their first loss reserves at the same time that bad debts are going through the roof.
Or raising capital just to pay dividends.
Yeah, or raising capital to pay dividends, as we kind of saw in one case.
All right. Let's get to the next one. Drew, hold your question. And you only can pick one here. Best investment for Armageddon: USD, Bitcoin, government bonds, or gold?
Gold.
The words of advice, the best words of advice you've ever been given by anyone.
Had the opportunity when I was studying for a PhD at Cambridge University. Some of my haters out there, I do have a few haters who will hate me saying this.
We all do, mate. Don't worry about that.
Yeah, they hate it when I reference this. But I got a letter from the former Nobel Peace Prize winner, Henry Kissinger, the former US Secretary of State, who said when I was next to the US, drop by. So I went and sat down with him for about an hour, and he was super interesting. I think I was 25 at the time. And I said, listen, my exact words were, what would be your advice to a 25-year-old Henry Kissinger? And he basically said, don't make any long-term plans. He said that in that baritone, sort of very distinctive voice of his, when he was at Harvard doing a PhD, all of his contemporaries had these grand 5-year plans. He said, what you really want to do is just, in the words of another person I spent a bit of time with, Malcolm Turnbull, you want to capitalize on chaos. And really just capitalize. And what he meant by that, I don't think he used those exact words, but what he said was, you want to capitalize on every opportunity as and when it arrives, really ruthlessly and relentlessly. He did say to me, which I think was an interesting remark. He said, whilst you're young, make a name for yourself intellectually, and then just optimize. And that's actually, we're big believers in our portfolios and exploiting short-term mispricings, and I'm a big believer in getting the short term right and chaining that together over the medium and long term. I do think that people who think that they can forecast in the long run are absolutely misguided, because uncertainty grows with time. It's much easier for me to predict where you guys will be in the next 30 minutes. You're going to be on the Zoom call as opposed to the next 30 hours. I have absolutely no idea where you'll be in 30 hours. And that's true of also investing.
Probably on another Zoom call.
Yeah.
All right, and the last question. In a world that lacks leadership, who's the most inspirational leader at the moment?
Most inspirational leader right now. Listen,
You can pass.
We're from Victoria too, so
yeah. I sympathise with your plight, old Dan. But the good news is he's seen the light, and hopefully you guys are coming out of lockdown in a fast and furious way. Yeah, but listen, it's hard for me to say who's the most inspirational leader. The one thing I will say, and this is just speaking from personal experience,
Trump.
The person the group of individuals that I'm most interested in right now are NFL coaches. I think the NFL is a really strategic sport, and they have a really complex optimization problem to solve. They've got these incredibly talented athletes. They've got very high attrition rates. They've got this real large dependency on one particular player, which is the quarterback. And it's something I've got interested in over the last year or two. And I think that the complexity of the game planning around NFL plays at the same time as needing to motivate very, very large teams of, presumably, fickle and frisky sort of, 20-something athletes is just interesting. So I'm looking into the sporting domain right now for inspiration for myself.
I guess they have very specific roles in NFL too, don't they? So it's, building a team of many moving parts, but ultimately rely on one or two.
Yeah, and the complexity embedded into the game planning is quite breathtaking. And I see actually strong analogies with investments and also my team. So I've got 25 guys, and there are really interesting parallels. I've got I've got 10 engineers, mathematicians, and physicists in my 25-person team. 4 of those guys have got PhDs. 2 of them have got university medals. So we've got 5 data scientists and 5 credit researchers and a chief macro strategist. And then I've got portfolio managers in Sydney, Melbourne, London. Actually, Sydney and London, the PMs are. But those guys are also very quantitative. And managing that group to maximize the performance of the team is a really interesting day-to-day challenge. I really enjoy it. We're an incredibly harmonious sort of egalitarian team. It's a very flat structure, but I think it's fascinating. The human condition, people generally, I'm not a huge fan of people generally, frankly. I find dealing with people generally a bit of a challenge, and I like spending a lot of time thinking by myself. I'm a bit of a lone wolf in that regard, but my team's like a family, and just managing that team's a really enjoyable experience. But I do see analogies with NFL coaches.
Everyone has a playbook on their arm walking around the office, or not quite at that level yet?
Well, I actually like to think of our team as an integrated neural network. So you've got 25 brains that are networked, and we try and maximize information flow. So we have 10 to 20 calls a day. I'm speaking to them on weekends. I was speaking to one of my data scientists at 10:30 last night. I was speaking to my PM in London at 9:30 last night. We had our 8 a.m. call this morning. But for us, the market is such a big beast. The financial markets are such a formidable adversary. It's very hard to beat markets as an manager. Very, very hard. I'm lucky because I work in a very inefficient market, which is over-the-counter credit or OTC physical bonds. The equities market is probably orders of magnitude more efficient, and therefore difficult to get alpha or excess returns out of on a risk-adjusted basis. But our job is to use those 25 brains to effectively vacuum up as much insight and information as possible, to synthesize it as quickly as possible, distill it down, and then make decisions as rapidly as possible. And doing that is it's a constant iterative process where you're constantly tweaking different parts of the network, repositioning them, trying to optimize them, plugging in new brains. So we've just hired a chief macro strategist, Kieran Davies, who is a chief economist at NAB, Barclays, ABN AMRO, and he was also head of forecasting at the Commonwealth Treasury for the purposes of the government's budget. And so that's a new capability that we've plugged in. And so now I'm thinking about, well, how do I monetize that? And he's actually just published 2 new research reports that are on our website. And those research reports are examples of the way in which we're trying to leverage his insight and plug his brain into my brain.
We might move into the questions. So we thought we use all 3 of your retail wholesale funds, so the cash fund, higher income, and the long short credit that we have in our defensive alternatives bucket. So can you just step us through those 3 products from your perspective and what they do and what they hold in kind of a short format?
Yeah, I mean, basically we offer, as you mentioned, 3 core strategies. We have actually a 4th, which I'll just touch on quickly, but the first is the Smarter Money Fund. That has a target return profile of 1 to 2% per annum above the RBA cash rate. It has typically an average credit rating of A to A plus. To give listeners an example of what that means is Suncorp and Macquarie Bank are both rated A plus. Bendigo and BOQ are rated BBB plus, so lower. It offers daily liquidity. Typically, it holds about 35% of the portfolio in cash, deposits or cash, securities, and the remaining circa 65% of the portfolio in bank-issued bonds that are floating rate, much like a variable rate investment account or deposit. So you can have fixed rate bonds and floating rate bonds. A fixed rate bond is like a 5-year term deposit. A floating rate bond is just a bond that has pays an interest rate, which is a spread that is a margin above a benchmark or a proxy for the RBA cash rate, known as the bank bill swap rate.
And how do you define cash? Is that a week maturity, daily rolling money market?
Our cash is pretty much all our core deposits.
Yep.
So you got, again, 35% cash, 65% floating rate notes, average A rating, targeting 1 to 2% over the cash rate. And historically, I'm just pulling up on our website. You can go to the performance tab and have a look at the historical returns. But in the Insto class, which is a publicly available class, historically we've done about 1.6% net of fees above cash.
Is it daily liquid fund, Chris?
Yeah, that's right. And in the last 12 months, we've done about 1.3% net above cash. Now, obviously, I've got to attach the usual caveats here. Past performance is no guide to future returns. Please read the PDS to understand the risks. And please take note of all the disclaimers on our website. The second product we run is called the Smarter Money Higher Income Fund. The name's actually a little bit misleading. It's very similar to the first product. It's rather than taking 1 to 2 over the cash rate, it targets 1.5 to 3% over the cash rate. Historically, it's done a bit better than that, about 1.71% over the RBA cash rate. In the last 12 months, it's done better again. It's done about 2.05% over the cash rate. So in the 12 months to 30 September, it's returned 2.5% net of fees. Very similar. Rather than holding 30% in cash, it holds about 15% in cash. Typically, the rest are floating rate notes or fixed rate bonds hedged to floating. The average credit rating is also in that A band. So just less cash, more bonds. There are some other slight differences in the mandates, but again, read the PDS to understand the risks. And the final product that we were talking about was the Smarter Money Long Short Fund. That's quite a different product. That targets 4 to 6% over the RBA cash rate. So a much, much more aggressive return target. In the last 12 months, it has returned about 3.9% net of fees. Obviously, a very volatile 12 months. March, we had this huge 1 in 100 year shock where equities were down 21%. And that is basically a high octane version of the second fund. So it targets 4 to 6 over cash. It is also holding basically all floating rate notes. So it has no fixed rate bonds, or if it has fixed rate bonds, it hedges out the interest rate risk. The average credit rating is again in that A band. It doesn't hold much cash. So it's basically fully invested in contrast to the first 2 funds. The other thing that we can do is we can apply some gearing. So we can gear the portfolio to further improve the returns. Basically, that particular product competes against high yield bond funds. Another way of looking at all 3 products is just looking at their current running yields. So right now, the long short credit fund's running yield is about 5%. The Smarter Money Higher Income cash plus 1.5 to 3% strategy running yield is about 2%. And the Smarter Money strategy running yield, the first fund, which is taking 1 to 2% over cash, its current running yield is 1.6%.
So I got a couple of questions, which is when you put it in cash, do you get the same rate as we do, 0? Or are you able to negotiate a better rate on the cash that you're holding within these 4 billion?
We've definitely been able to negotiate much better rates on our cash. But I would say that, we do have the ability to negotiate, but we generally get pretty good rates. I would say in the upper quartile of the rates you would find that are publicly available. Obviously, we have much more money in our cash holdings, so we're going to have hundreds of millions of dollars rather than, say, $500,000. But to give you a sense of what we're earning on our call cash, at call right now we're earning 0.63. We don't have much of our portfolio in our at call cash, but 0.63 is obviously a hell of a lot better than 0.25, which is presumably
0.0.
0.0.
Like for most of them. I was going to have a quick link was to compare, or basically you hold only government, semi-government, and bank debt. That's correct, isn't it?
That's right. I mean, we in those portfolios will generally be mostly focused on bank bonds. Yeah. We do have the ability to buy and sell government bonds. So right now, for example, we have about 30% of those portfolios in state government bonds, so AAA rated and AA rated state government bonds, mainly focused on New South Wales, Queensland, and South Australia. We think those securities have been very cheap. We think the RBA will likely do or launch something known as quantitative easing next month, which means buying government bonds, including state government bonds. And we think given that the performance of those bonds will be quite robust, and that's certainly what's happened since we started buying those securities in August. And in fact, in October, we're having one of our strongest months on record to date, partly because we've seen very good performance out of those securities.
And is that because you focus only on the bank bonds because of the credit rating, or is it because of the regulation and the APRA kind of reporting that they have to do as well? Like you haven't drifted into corporate bonds or, as you were saying, high yield?
Yeah, so that's a very, very interesting question. So we, just to abstract away a little, we have the ability to buy and sell any investment grade corporate bond, bank bond, or government bond. So we actually have a lot of freedom and flexibility in our portfolios. But philosophically, our principle is we only want to hold businesses that are basically too big to fail. Businesses that in any recession are not going to remotely come close to defaulting on their debts. Businesses that are ideally government guaranteed or implicitly government guaranteed. So we do actually invest in corporate bonds occasionally. In the last 12 months, we've held Woolworths senior bonds, and Woolworths is a good example of a very, very strong oligopolist, or a duopolist, arguably, with Coles. We've also held Coles senior bonds. We've held things like Singtel Optus's senior bonds. In the past, we've held Apple. But in the main, we don't hold corporate bonds. We just enter that market when we see mispricings that mean we're going to get capital gains from the bonds. In our portfolios, we're really focused on generating capital gains, not yield. In fixed income, the best proxy for risk is yield. You see a fund with a higher yield, that's generally going to be compensation for more risk taking. And the normal paradigm in fixed income is you chase risk in order to get a better yield. And the three big risks you can chase are the risk of a bond issuer defaulting, so credit risk, the risk associated with being stuck in a bond and not being able to trade it, or liquidity risk. Yeah. And the other third major risk is interest rate volatility risk. So if you invest in a 5-year term deposit and you fix your interest rate today, let's just say at 1%.
0.8.
0.8.
Maybe you're getting one.
and let's say for whatever reason the RBA's been lying to us of late, and they normalise the cash rate back to about 3.5% at some point over the next 5 years. Well, you will have done really badly on that 0.8% TD fixed for 5 years. And if you actually tried to trade it or sell it, you'd have to accept less than 100 cents in the dollar. So that's the way a fixed rate bond works. If your outside interest rates go up and you fix your interest, then the bond price is going to fall, so that any buyer of that bond is going to be indifferent between another bond paying a higher interest rate, and the bond that you're trying to sell that has a lower coupon but has a higher yield because the price has fallen to make the yield the same as external interest rates.
Is that a good segue into how you, so the bonds you're buying offer, 10-year government bonds are like what, 0.7, 0.8%, but you're delivering double that over the cash rate?
Yeah, so the bonds that we're purchasing in the semi-government space are probably paying anywhere from 0.5 to sort of 1.3%, but we're not there for the yield. As I mentioned, we're looking for the capital gains. So, and we've actually got tremendous capital gains over the last 3 months on those securities. And the way we can get a capital gain is, and this is really the focus of our process, we take all of our internal capabilities. So the 25 staff, the 13 analysts, the 4 PhDs, we use up to 30 to 40 quantitative models that we've built in-house to value every bond globally. And what we're looking for is mispricings, basically bonds that are paying too much interest for their risk, and that bonds that will appreciate in price over time. And typically we find that those mispricings disappear over about 3 months. So the interest rate normalizes, or it sort of mean reverts back to fair value over that period. As that interest rate does normalize, the price of the bond rises. So it's kind of like, I think for the lay listener, it's kind of like, imagine that Ubank has an incredible term deposit rate. They're offering 1.5% for 6-month money. Now they'll do that because they want to attract funds, but they'll only hold out that special for, say, a period of time. And let's just say, whatever, 3 months, they get the money they want. You buy the 1.5% TD, and just imagine that you could actually sell it. So you could trade it, and you could sell it to your best mate or your next door neighbor, not on a 1.5% interest rate, but on a 1% interest rate. Well, if they're buying at a much lower interest rate because Ubank's pulled the special, and now the typical 6-month TD rate is like 0.5%, and you've got a TD paying 1.5%, if he's willing to buy it off you at a 1% interest rate, he's going to pay you more than 100 cents on the dollar. You actually get a capital gain, and that's what we do. And that's a much safer, more secure, consistent way to generate returns than just chasing risk. So coming back to your question about corporate bonds, we're focusing on businesses that are too big to fail, that basically don't have any credit risk, and they tend to have high credit ratings. So your intuition about the banks, yes, because the banks are partly government guaranteed, they benefit from high credit ratings, their bonds tend to be much more liquid. So in the month of March, I bought and sold over $1 billion of bonds. Now, what we saw in March is a lot of fixed income managers had no liquidity. Their assets were frozen. Now, there'll be you heard lots of complaints and explanations and I think rhetoric around why there was no liquidity, but I had lots of liquidity. We were trading $1 billion worth of bonds in that month. And there's a simple explanation as to why those portfolios had no liquidity. And that's because if you own bonds issued by companies that are going to perform badly in a recession, you're not going to find a bid for those securities, right, in a recession. So we're in a recession in March, and guess what? Nobody wanted to buy Virgin senior bonds, right, which ended up being worthless because Virgin actually defaulted on those bonds. Nobody wanted to buy David Jones bonds. Nobody wanted to buy bonds issued by subprime non-bank lenders like Pepper or Latrobe, on the basis that riskier borrowers have higher probabilities of default in a recession. And nobody wanted to buy bonds issued by commercial property investors because the whole commercial property market was screwed.
Yep.
Obviously no one was paying rents, tenancies were getting hard to fill because business models were disaggregating. The whole Zoom phenomenon that we're capitalizing on right now, that means that people don't need as much office space as perhaps they once did in the past. We didn't have those problems because we actually sold all our corporate bonds in January ahead of the COVID crisis. We radically de-risked our portfolios. In fact, in the month of January, I sold more bonds than I ever have in the last decade. We sold about 1.14 billion in the month of January. And then, and credit spreads at that time were very tight. So, our market, it looked quite expensive. And then in the month of March, credit spreads exploded. We saw spreads move to their highest levels ever recorded, worse than in the GFC. And that's why in March, we bought a lot. I bought about $867 million in the month of March.
How does that, sorry, I'll keep taking all the questions, Jamie. How does that liquidity work? I think you're explaining to us, basically, there's no ASX for most of the bonds. You're just calling every other manager and seeing one if you could sell and one if you could buy.
Well, the way it actually works is you have market makers, which are generally banks or brokerages, and they act as intermediaries between the buyers and the sellers.
Yep.
And the participants in the bond market will be fixed income funds, there'll be super funds, there'll be offshore central banks, offshore fund managers, insurers. There's quite a range of potential investor cohorts. Also, retail investors, mid-market investors, private banks, high net worths, family offices, councils, and so on. And so we trade with a very, very large number of banks and brokerages globally. And so we have access to all of their counterparties and therefore all of their liquidity. And so what we'll do if we want to trade is we'll go to those counterparties and say, listen, where's your market in these bonds? And then we'll try and find the best price to execute. But we generally are very active. So it's, in the year to date, in 2020, I've bought and sold almost $19 billion over the last 10 months. So we are transacting about $100 million a day, and we're typically trading about 70 times a day. We do trade on the ASX as well because we're very active in the hybrid market for some portfolios. Some of our portfolios aren't allowed to invest in hybrids. And then we're quite active in the unlisted bond market. But most of our trading by size will be in the traditional over-the-counter bond market. Not much of our trading, less than 10% of our trading is actually in hybrids.
So, Chris, we haven't written this question down, but for a lot of investors and potential investors, clients of Wattle Partners, one of the alternatives that they get pushed to them by other groups is a index option, a composite bond index option. It's relatively cheap, 20, 30 basis points. For us, we see risk all over that, and we've probably seen risk all over it for too long. But we don't think that the coupon that you would get paid is for the potential risk. First, holding how the structure of the portfolio is. The company with the most amount of debt is the biggest portion of the index fund, and then the average duration is closer to 6 or 6.5 years. So we see risk in potentially interest rates increasing and potentially people that are invested in that index fund getting effectively hurt in terms of capital. Do you share that view, or do you have a different view?
Yeah, I mean, I'm generally sympathetic to that view. We've argued that the global financial crisis, which really resulted in the unveiling of this idea that central banks can buy bonds, to bid up their prices and to lower their cost of capital, to lower interest rates. So a central bank normally controls the overnight cash rate. That's what the RBA does, and that's kind of like an overnight bank deposit rate. And then over time, as those overnight cash rates have come down to zero, which is known as the effective lower bound, the central banks have started saying to themselves, well, we need to influence other interest rates. So rather than just the overnight rate, we want to put downward pressure on the 3-year interest rate, the 5-year interest rate, the 10-year interest rate. To do that, they need to buy bonds. And this is what the RBA is likely to do in November. So the RBA has already moved to buying bonds around the 3-year government bond yield, or effectively what is known as the 3-year risk-free rate. And for many months, we've thought that they will go further out the curve and seek to put downward pressure on the 10-year government bond yield. And when central banks do this, so they embark on this QE and they start buying all manner of assets, and they start printing money in order to do that. Our view has been that ultimately this ends in inflation. So it's actually becomes, because you're not fixing the money supply, you're increasing the quantity of money.
Yep.
And the history of money suggests that this pattern of behavior ultimately becomes quite inflationary. Now, the GFC was a deflationary shock. COVID-19 was a deflationary shock. But my view is that over the next 5 to 15 years, at some point, we're going to see a big increase in inflation. If that's the case, you don't want to have what is called interest rate duration, which is basically the risk of holding long-dated bonds that have fixed interest rates rather than floating interest rates. Because as we discussed earlier, if inflation comes and long-term interest rates start to creep up because the market thinks the central banks eventually will have to increase interest rates at the short end or the overnight cash rate, then the value of those bonds will fall. So duration is a risky thing to hold in a portfolio. In our 3 strategies that you guys use, we're quite unusual because we actually calibrate our portfolio duration at 0 years. So normally a fixed income manager that is a short duration manager will have about 1 to 2 years worth of interest rate risk. We actually have 0 years interest rate risk. And that means in months where yields start rising and you see that composite bond index, which is only fixed rate bonds, there are no floating rate bonds in that index with an average tenor or maturity of circa 6 years, that will perform abysmally. So it'll be down 1 to 2% in a bad month when long-term rates start rising. And our portfolios will likely outperform in those scenarios. Having said that, we do actually run something called an active composite bond strategy. Now, this is a product we only run for super funds, but we are making it publicly available soon. And it is benchmarked against the composite bond index. And we have beaten that index by 190 basis points or 1.9% before fees over the last 8 years. In the last 12 months, we've beaten the index by 2.96% or almost 3 percentage points or 300 basis points.
But that's an active bond fund, right?
Yeah, that's active. So that basically takes our active trading style and we fix the duration of our portfolio to the index duration. So we're not going active on our interest rate risk. We're just holding it at the index level. And then we beat the index through our trading and our ability to find mispriced bonds that are paying too much interest that will appreciate in price as the credit spread normalizes to our target. But I do think that the duration in the medium term will be problematic. It's been a very, very good building block in a portfolio for the last 30 years, but it was a very bad building block in a portfolio for basically the prior 70 years. So I think we're going to a new regime, which will be a much, much more inflationary regime. And that will be amplified by things like deglobalization. But one of the things we're seeing is a decoupling between the US and Chinese economies, but also a decoupling between the Chinese economy, which historically has been the world supply chain, and a lot of Western economies. And we're seeing a process called reshoring. And that means that Western companies are now saying they don't want their supply chain based in China. They want it based locally. You're seeing a huge push amongst Western and liberal democratic nation states to locate their critical supply chains domestically. We're seeing this here in Australia. The Prime Minister's talked about it a lot. We're seeing the Japanese pay their companies to bring their supply chains home. I think 75% of all US businesses are thinking about reshoring their supply chains. And what that will mean is you'll likely have higher production costs, because the reason—
You should get that, Chris.
the reason the Chinese have become the supply chain to the world is they had some artificial comparative advantages. They had very, very low wages in their country, so labor costs were very, very low. And then the state was subsidizing with basically free loans or near free loans a lot of the national champion businesses that dominated global supply chains. So the best example of that would be Huawei. Now, Huawei has dominated global telecommunications supply chains and has benefited from really cheap state funding, which meant it could loss lead and undercut other telco providers and disintermediate them from their traditional markets because China wanted to control telecommunications infrastructure. So as that whole process unwinds, you've seen Huawei banned from the NBN, and Huawei is being basically booted out of the US, Canadian, UK, and now some European markets. You're going to see the cost of production increase, the cost of providing goods and services increase, at the same time as you see huge fiscal stimuluses globally, some massive budget deficits, concurrently or contemporaneously with massive money printing. All those roads are pointing towards higher inflation, which means you probably don't want duration in portfolios. You want to be floating rate, you don't want to be fixed rate.
Can we turn the conversation now to economic outlook, or more importantly, residential real estate, where nearly every investor's largest asset class is residential real estate. So everyone is super keen to know about residential real estate, and you have quite a contrarian view versus the mainstream press on residential property over the next 12 months.
Can you call it contrarian if it's right?
No, contrarian. Well, I don't know. I think it can.
When everyone else is so far wrong, is it still contrarian?
Yeah, that's right. That's right. And the funny thing is that, and this is the bane of my existence, every time we have these sort of iconoclastic or highly contrarian positions, they become the consensus views because ultimately they get validated. If I can just screen share, I'm not sure if you guys, I think you can, you need to make me the host in order to be able to do that. But if perhaps your administrator could just allow me to screen share by making me the host. There we go. And I'm going to show you a chart. I'll show you a few different things. Here's this chart. So there. So can you see that chart?
Yep.
Cool. And basically, yeah, we did have a contrarian view. So in March, I went onto a podcast, the Jolly Swagman podcast, and basically, you know, we've been fairly public in telling our clients that we thought that the doomsday forecast for Aussie housing that started to materialize in March were totally wrong. So basically, you had all the major banks predicting 10 to 20% house price falls, and you had many others, including you know, UBS and Morgan Stanley predicting 15% house price falls. AMP forecast a 20% drop in house prices. SQM were up to 30%. And basically, we had a completely different view. We said that house prices would fall by only 0 to -5% over a very short 6-month period. Now, at that point in time, we did not anticipate Dictator Dan's second wave, right? So the snafu around the quarantining in Victoria, which you know, explains 99% of the COVID infections in Victoria, that wasn't part of our central case. Our central case was that there would be no additional second wave in Australia. And that's been true of 7 of the 8 states and territories, and also true in New Zealand. And then we argued that after that 0 to -5% correction, the market would start turning in circa September. And basically, that's exactly what's happened. So in the period since the market peaked in April, house prices have fallen nationally only 2.8%, right in the midpoint of our forecast range. And we started to see house prices rise across 6 of the 8 capitals in September. So in the month of September, house prices rose in Perth, Canberra, Hobart, across all non-metro regional markets, in Brisbane, in Adelaide, and in Darwin. The falls in Sydney were very small, at only -0.3%. The one laggard was our southern brothers and sisters, obviously Melbourne, which continues to tank, unfortunately. But even in the Melbourne market, we're now starting to see some stability. So in October, we're seeing house prices in Sydney now rising. We're continuing to see very strong auction clearance rates. So over the weekend, the Sydney auction clearance rate, the preliminary number was 82%. In Canberra, I think it was around 85%. In Adelaide, it was 88%. But what was really encouraging was that in in Melbourne, the auction clearance rate was in the, I think, the low 70s on pretty good volumes for the first or second week that the auction market has started to open back up in Melbourne. After this turning point in September, we forecast that we would get at least 10 to 20% capital growth. Now, we have a long track record of getting these cycles right. I wrote a report, a 380-page report on housing for Prime Minister John Howard in 2003. And I led the team that developed the CoreLogic house price indices that the RBA uses. And we got the 2008 correction right. We got the 2012 to 2017 boom right. In 2017, we were the first analysts to say the boom was over and house prices would fall 10%, which they did. And then April last year, we were the first analysts, whilst prices were still falling, to say that the bust was over and the prices would boom another 10%, which is exactly what they did in the period between June last year and April this year. Prices nationally were up 10%. The RBA's research shows that a 1% drop in mortgage rates as of January 2019 would propagate a 28% increase in house prices. And that was basically our view that this cycle would get 20 to 30% capital growth this cycle. That's what we're expecting. So we got 10% between mid-19 and April 20. We then pulled back 3%. So we're potentially owed up to another 23 percentage points. Conservatively, we're saying we're looking for at least 10 to 20% capital gains now. I'm very, very bullish resi, and that's why that's one of my greatest recent regrets, not kind of putting a little bit of excess cash into some 10 times levered resi through a 10% deposit and a 90% home loan.
And does responsible lending laws play into that as well? So you're saying cheaper mortgages allow people to...
There's actually a bunch of stuff that plays into that. We've seen fixed rate mortgages come down 150 basis points. We've seen actually household incomes rise, not fall, strongly because of the huge fiscal stimulus that ScoMo and Josh Frydenberg have bequeathed on the country. So we've got one of the most generous fiscal stimulus programs of any country, any developed country in the world. So we've actually seen a big increase in purchasing power. We are now seeing the advent of positive gearing. So you can get gross rental yields quite comfortably on apartments of 5% or more around the country. And you're paying 2.5% on a mortgage. So we're not seeing negative gearing, we're actually seeing positive gearing for the first time in a very long time. We're seeing massive demand from Asian buyers and expats returning. Contrary to claims, there's no population growth. What is not in the population numbers is that 480,000 Australians have returned from overseas as a result of COVID, which is a huge boost to the population. And there's probably a large number waiting to return. And then if you think about net overseas migration, the government's sort of talking this down, but I think what you're going to see is a massive boom in net overseas migration over the next 5 years. Because basically, if you're living in Taiwan, Hong Kong, mainland China, in the UK, Europe, or the US, Australia right now is one of the most attractive destinations in the world for a whole bunch of reasons: political stability, health, the physical amenities, the economy, commodity prices are high. I mean, we have a lot to be very, very excited about. There was an example in Sydney, in my suburb, Vaucluse. A property went to market a few weeks ago to auction. The reserve was 14.6 million. Above that, they would have traded it. It sold for 24.6 million to a Chinese buyer. 22 of the 25 contracts were Chinese buyers. Agents are telling me they're doing Zoom inspections with Chinese buyers. So watch this space.
So we shouldn't be too worried about JobKeeper finishing in March or April?
Everyone said to me, oh, what about the September JobKeeper cliff? I was like, dudes, it's not going to be a problem. Don't worry about JobKeeper. Look at the radical reduction in the number of people on repayment holidays on bank balance sheets. I mean, between August and October, there's been a huge drop. I think the numbers were for CBA that 28% of their SME borrowers were on repayment holidays in August. And as at October, only 7% were. So, and Bendigo has also, I actually just put this up on my LinkedIn profile, but Bendigo has reported something like a 75% reduction in the number of folks on repayment holidays in certain parts of its balance sheet. So, listen, I'm a big believer in the elasticity and adaptability of the Aussie economy. Whilst we're not getting, obviously, foreign tourists, there's a huge boom in domestic tourism. And more people actually travel from Australia overseas each year than those that travel here each year. So basically, I think that the tourism market, once the borders open, can do really, really well. I know that the Queensland border for a New South Welshman is meant to be opening up this Friday, and I'm looking at booking, Queensland holidays immediately.
I've already booked 3 restaurants before the end of November.
No. We're quarantining you Victorians.
No, in Victoria.
Yeah, we're keeping our borders. It's going to be airtight.
And everyone around me are building new swimming pools. So money that would have been spent offshore is being spent here.
Or the other phenomenon we've seen in Sydney is buying holiday houses. Like the holiday house market's going gangbusters. But
that's because you can work from anywhere now, right? It doesn't really matter.
I spent my lockdown in Joye, which is like 2.5 hours out of Sydney, running a 25-person team, no problems.
All right, Chris. I sort of had one last question. Sorry, Jamie.
All right.
I've got all the time in the world, guys.
Which was how long?
Running for 56 minutes.
How long are rates this low for? So you said that you're going to expect inflation. When do they go up? Because
I don't think we're going to be worried about inflation. I think it'll be a slow-moving beast. It's a little bit like kind of moving or turning a super tanker. And the reality is the jobless rate's high, 6.9%. It might drift up a little bit. Again, our forecast is it'll sort of settle around 6 to 7. Which has been true thus far. But it's going to take a long time to get wage inflation running again, which will really need to see the jobless rate below 5%. So I think it's years away, and I think any rate changes are years away. I also think that the RBA and the Fed and other central banks are going to tolerate high levels of inflation for a period of time. So it's not like we're going to hit 2%. And they're like, oh, we're going to lift rates. And actually the very erudite governor of the RBA, Philip Lowe, has said that they're not going to change rates based on their forecasts. They're only going to lift rates when they actually see the whites of inflation in the actual data settling comfortably in the midpoint of their target band, which is 2 to 3%. So I think we're several years away. I think rates will remain low for long.
Okay, Chris, thank you very much for the last hour. You did ask for us to keep it short so you can go and trade some bonds, but we've successfully saved you 2 minutes. But appreciate you and everything you've done for our clients and managing capital and spending the last hour on this call and all the calls you do with Drew and I throughout the year. So thanks, Chris.
Can I say, guys, I mean, you guys do a great job. Very, very impressive team at Wattle. Obviously, I know a lot about the business. The founder of the business, his daughter, Mel Donnelly, is actually the chair of Coolabah Capital. And Melda was formerly CEO of QRC in Queensland, and I think she was director of both Uni Super and VFMC, and she's also a Victorian. I would like to just say, for the record, that I feel very Victorian myself. I went to school at Geelong Grammar for my sins out in Corio, that lovely destination, and go the Cats. Obviously we pity their plight. We have 4 analysts, as I mentioned, based in Melbourne. And I was also, of course, and I'm sure you're aware of this, the vice captain of the 1994 Victorian schoolboys under 18 first 15 rugby team. I was a barrel-chested, rampaging hooker in the front row. Awesome. bit of a big rig. So I have very much Victorian heritage flowing through my veins. The other thing I'd just like to say to your viewers is, it's very humbling for us to meet you guys. I've met a lot of you in person, and I'm always blown away by the interest and wisdom and knowledge that you bring to bear when we engage with you. So it really is, again, very, very humbling to be a servant in the context of your savings.
And the next session could be on drones.
We haven't even talked about my shark tracking. Coolabah Capital, I'll just give that a plug. 2 plugs. Go to our podcast. We have a podcast, Complexity Premier, that you can listen to and hear myself and Ying Yi discuss topics of the day each month. But more significantly, in our spare time, Coolabah runs a search and rescue drone surveillance capability where we are flying off Sydney's beaches looking for great white sharks and other beasts, bronze whalers, bull sharks, anyone that is threatening the population. You may be aware, some of you, that I think I was the first person in the history of humanity to use a drone with a live speaker system to thwart a shark attack. So the very first video if you go to Coolabah Capital Drone, if you Google that, you'll see the Coolabah Capital Search and Rescue drone site on YouTube. So we have a dedicated YouTube page. And the first video is taken at Werry Beach in New South Wales. And you can see this monster of a juvenile great white, probably about 4 meters in size, circling a surfer and then barreling towards him. And then I warn the surfer, you can't actually hear the audio, but anyway, I warn the surfer through the speaker system, and he gets the fright of his life because he hears my voice from, I was obviously situated a long way away, screaming at him, shark, 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 evacuate the water immediately, shark, shark, shark. So he gets the fright of his life because obviously he couldn't hear, like you don't actually hear the drone, all you hear is the voice. So he's like, oh my God, he whips the board around. And then that motion of whipping his board around actually shocked the shark as it was meters away from chomping this guy, and the shark bolted. So he obviously owes me his life, the surfer. But this video went completely viral. It went all over the world. It was on CNN, Fox, BBC. The BBC contacted me and said they wanted to run an episode of a series they were running on real life heroes on our shark tracking system. So obviously this is just a part-time job, but hopefully it humanizes the Coolabah Capital team for you all.
It's excellent. Thanks again, Chris. Really appreciate it.
Thanks, fellas.
And for the listeners, please join us next week. We'll be talking with ETF Securities about physical gold. So please join us then. Thanks, Chris. Thanks, Drew. Cheers.
Thanks.